Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. This is episode 121 of your Tax-Free Life podcast. First and foremost, I want to thank all of you that are sending me emails and reaching out by telephone to, pick my brains and some of the issues and concerns that you have regarding your retirement plans. Now, obviously, some of the questions I've been getting for the last couple of weeks, I would say probably the last 30 days or so, deal with guarantees, retirement distribution, tax planning, Roth conversions, understanding what, tax ramifications are going to be in the future and so forth. So once again, I appreciate all of you. And for those of you that have already reached out to me, you have noticed, obviously, the amount of quality information and education that I provide on every single phone call that we have on a weekly basis. Today's episode is going to be something different. It's going to be something that I'm hoping that you're going to start thinking outside of the box, because this is something that I see in American families each and every year, as I have been doing this now for a little more than 30 years. So the title for this episode is, Why Will 99% of American Families Remain Poor for Generations to Come? Once again, why will 99% of American families remain poor for generations to come? And there are three areas that I want to discuss with all of you today. One is understanding the family unit and the importance of the family unit when it comes to financial success and retirement planning. Number two is the realities of wealth and legacy in American families. And then last but not least, I want to talk about how to create wealth and legacy on pennies on the dollar. So let's get going, because I'm going to give you a lot of information. And once again, I think it's important for all of you to start thinking outside of the box and take a look at yourself and take a look at your family unit, whether you have kids or, grandchildren and so forth, and really start thinking from an outside of the box or, through a telescope as opposed to a microscope. Now, in discussing understanding the family unit, one of the things that I notice is that, there's a poor person mentality which actually destroys some viable family units. And this is something that I see often, where the majority of families that I engage, and I'm talking about the vast majority of them, not all of them, they basically plan for Saturday night only. And poor people usually have a tendency to only plan for Saturday night. The wealthy are planning 2 to 3 generations down the line, but the poor people are only planning for Saturday night. Now, most family units have no financial purpose other than procreate. Whenever I have a new client that comes into my office, or we do a video conference or whatever it may be, and they decide to engage my services, I ask a lot of questions, because it's very important for me as a retirement strategist and a tax planner to understand where they come from, to understand how they feel about different things when it comes to financial well-being and so forth. And every family is different. Some families are very pro-family oriented, and those are actually the few in between. But most American families have no financial purpose in mind other than procreate. And that creates a problem because at the end of the day, those families are going to remain poor for many, many generations to come. Another challenge is that, and this is something that I hear often, Bert, my responsibility ends when my kids move out of the house. And I couldn't disagree with that anymore. I mean, that is one of the major flaws that I see in American families today, that they just don't care. They're only thinking about themselves. They're being very selfish, and they're not thinking about the impact that they can have on the family unit overall. And that's something that is a major issue that we all need to consider and deal with at some point in time in the future. I think obviously mobility has had a positive and a negative impact on family values. And this would be primarily the expansion and reduction at the same time. What do I mean by that? Well, for decades, American families used to stay fairly close together, usually within the same city, the same town, the same county, obviously the same state and so forth. But technology and the internet and mobility has, forced many American families to kind of fall apart and move in different directions. For instance, you can have a kid if you live in Florida, you can have a kid living in California, like many of my clients have, or New York City or Boston or whatever it may be. So obviously you start to lose the tightness of that family unit along those lines. So the expansion is good because you're moving out of your environment and you're looking for other opportunities and better opportunities and so forth. But on the other hand, the reduction of the family values and the family unit within the family mole then obviously becomes worse and worse as time goes on. Another challenge that I see in understanding the family unit is that most families do not understand the importance of family unit survival and independence. See, a family unit, if you do it properly, and I'm going to be discussing some of those interesting points in the next few minutes, but if you do it properly, it should remain financially tied to one another. And on top of that, sentimentally tied to one another. So, most of the families that I engage for the first time really don't understand the importance of maintaining the viability of the family unit and its survival and independence. If you do it the right way, you can have a family that will be self-dependent or independent, from any governmental assistance and or any other type of entity that may want to try to take control of each member of that family unit. Now, most members of a family unit, and this is based on my personal experience after 30 years of doing this in financial services and tax planning, most members of a family unit have no unity concept and do not understand the value of a strong family unit. They're pretty much rebels without a cause, just like in the James Dean movie back in the 60s, or I think it was late 50s, it was called Rebel Without a Cause. But that's something very critical that I notice with many family. And again, because of the fact that they're being selfish, and they only think about themselves and they don't think about the next generation and the generation thereafter, that actually creates an unbonding concept, and it doesn't allow for the bonding concept to continue for generations to come. I would argue that a family without a patriarch is a failed family unit. A family without a patriarch is a failed family unit. Because at the end of the day, I'm a true believer, at least in my case, one for all and all for one, just like the Three Musketeers. And the closer you stay to that family unit, and the closer that the patriarch really thinks about the next generation and the generation after that, the better off that family unit is going to be, because at the end of the day, unless you do it properly, 99% of American families are going to remain poor for generations to come. And you would also notice that a successful family unit has a leader, has a pioneer, and has a patriarch. If you take a look at all the wealthy families in this country and how they started, and you name any family that you can think of, it actually started with one person. Started with one person that took an idea, took it to the next level, started to think outside of the box. They built businesses, but they were not really thinking about themselves. They were thinking about the next 2 to 3 generations, and by doing so, they became extremely wealthy themselves. So these family units are self-sustaining. They don't need anything from anyone. I deal with clients that are part of family units that are very large, and they have very large businesses, and they have a trust in place for the business, and the trust is dishing out income on an annual basis to family members. And then obviously the clauses inside that trust dictate what those family members need to do with that income in order to maximize the benefit of the family unit for generations to come. So always remember that, if you're a parent, and let's say you're married, both you and your spouse or significant other, can become leaders, can become pioneers, and can become patriarchs to the family unit. It has to start somewhere, so why not start with you? So those are some of the things that I deal with when I'm trying to understand a family unit when I first meet with them, in order to figure out what it is that I can best do for them and how to help them from a financial, economic, tax planning, and debt elimination standpoint. The next point I want to share with all of you deals with the realities of wealth and legacy on American families. See, most American families are working families. They may be professionals, they may be blue-collar workers, they would be traditional office employees, but most American families are working families. And what that tells me is that personal economies are limited and ill-stretched. And many times, these families are making money, and they have very good jobs. And many of them are making a lot of money. But it's not how much money you make, but most important, how much money you keep. So these families are doing all kinds of things that are taken away from their capability to become savers, to become pioneers, to create legacies not only for themselves, but also for their children and grandchildren along those lines. Now, most families that I see, they kind of prefer to drive an expensive toy as opposed to protecting the family unit. And by the way, there's a major difference between a toy and a tool. See, a tool is tax deductible, a toy is not. And what I find many a times is that, these families are driving big, expensive cars, and I'm not saying that you shouldn't drive one. But make sure that you start thinking about the family unit and the well-being of the family unit, not only for yourself and your family in retirement and throughout the education of your children and grandchildren and so forth, but start thinking outside of the box. Start thinking through a telescope as opposed to a microscope, and try to build wealth for future generations to make it easier for them, or at least to give them the opportunities that perhaps your parents were not able to give you, or your grandparents were not able to give you from a business standpoint. So you always got to think that the future is going to be, a little bit harder for you and a little bit harder for your children and grandchildren than it was for your parents and perhaps even you from that perspective. Now, a small percentage of American families own a business, and that is why most American families are, the working class. But a small percentage actually own a business. The challenge is that most businesses die at the first generation. Very few businesses, and I do have a number of business owners that are clients of mine, and very few of them actually have their kids working in the business. And many of those that have their kids working in the business, the kids don't want to work in the business for the long term. They're waiting for their parents to pass on, and then they're looking for a way out. They're looking for the opportunity to sell their business and go do something else. So very, very few American families that have businesses, can actually think long term. Unless obviously you have a very successful business and then you want to take it public, and then obviously that would be a different set of circumstances altogether. Now, because of it is very difficult to understand the family unit, and most Americans do not understand the value of the family unit, and the fact that the realities of wealth and legacy in American families is one that most Americans do not understand, and most individuals within that family unit do not understand. I want to spend a little bit of time with you talking about how to create wealth and legacy on pennies on the dollar. See, unless you have a very successful business, there's still it's going to be a little bit more challenging for you to build wealth, but there are ways in which you can build wealth pretty much by creating a legacy with a mere stroke of a pen or a mere signature. See, and life insurance plays a major role in creating wealth not only for yourself but also for your family. Now, I'm not going to talk about the importance of life insurance when it comes to tax planning and retirement distribution planning. I'm not going to talk about, the inside account savings that build up, the cash values inside of those accounts, and what they can do for you and your family from a taxable standpoint, and also from a retirement supplement standpoint. I want to take a look exclusively on this podcast on the death benefit side of a well-structured life insurance contract, and what it can do to create wealth and legacy for your families at the mere stroke of a pen or a mere signature. Now, the first thing to do that I recommend to many of my clients, now some of them do and some of them don't, but eventually those that are thinking about creating a family unit and creating a family bank, if you want to think of it that way, think of it as creating a banking institution, with a mere stroke of a pen. Is that I asked them to create an irrevocable life insurance trust, and introduce family protection clauses inside of that legal document that creates the irrevocable life insurance trust. So let me give you an example. Let's say a husband and wife decide to create a family bank, not only for themselves, but also for their children and grandchildren. So a husband and wife should own permanent life insurance equal to their human life economic value. See, you got to take a look at the human life value of every single member of that family unit and buy enough life insurance to make certain that you can take with you that family economic value. See, life insurance for the most part in the United States is purchased, to cover expenses or on a needs-based or on a goals-based, and you're leaving a lot of money on the table. And once you lose that family unit value or that economic human life value, you're never going to be able to recover it. Now, hopefully your survivors will, or the next generation will. But if you didn't do it for yourself, what makes you think that your family is going to do it for you and for everyone else? So if you're a husband and wife, you should own permanent life insurance equal to your human life value. And depending on your age, depending on your income, you can do a multiple of 30 times, 20 times, 10 times, and then you can purchase that in permanent life insurance. Now, this life insurance contract or these life insurance policies that you can purchase to create a legacy and to create wealth could be a first-to-die policy, meaning, when the first person dies, that death benefit is going to pay out. Or you can use second-to-die policies that are usually utilized for either estate planning purposes or for legacy creation purposes. Meaning that if you buy a life insurance policy in the name of a husband and a wife and it's a second-to-die policy, the life insurance contract is going to pay a death benefit upon the second death, which is usually that time where if there are any estate taxes that would be due, then most estate taxes are payable at the second death. Now, it really depends. You can buy either first-to-die policies, you can buy second-to-die policies, you can buy a combination of both. It really depends on your finances, what you want to do, how you want to structure that trust, and then obviously a viable and intelligent financial and retirement strategist and insurance planner can actually help you along those lines. Now, the ILIT, as they call it, the Irrevocable Life Insurance Trust, is also known as an ILIT, should be the owner and beneficiary of the life insurance policies. Now, can you own a life insurance policy on yourself? Of course you do. The vast majority of Americans buy life insurance policies, and they are the owners, they are the beneficiaries, and then someone else is going to be, my apologies, they're going to be the owners, they're going to be the insureds, and someone else is going to be the beneficiary. So in my case, the beneficiary for my contract would be, let's say, my wife, and then my contingent beneficiaries, if something were to happen to my wife along the way, would be my children from that perspective. But if you're going to create a legacy planning, or you're going to create a family bank, the Irrevocable Life Insurance Trust, or ILIT, should be the owner and beneficiary of the life insurance policy. And you also have to think that an irrevocable life insurance trust is a valuable business entity. And you need to treat it as a business entity because it's going to have a tax ID number. And if you do it properly, you're going to be able to do things inside of that trust that no one else is going to be able to do unless they understand the parameters of how that trust works. Now, what are some of the clauses that should be provided or included inside of this family bank or family trust or ILIT? There are many of them, but obviously I'm not going to talk about a lot of them, but I want to give you some of the major ones that I think are hopefully going to get you to start thinking outside of the box. Now, it needs to have, obviously, long-term care protection, not only for yourself, but also for your surviving spouse as well. So many of the life insurance policies that you can buy today actually have long-term care riders. So if you have a need for long-term care benefits, then that trust can actually pull money out in order to pay for the added expenses or the increased expenses due to a long-term care illness, not only for yourself, but also for your spouse at some point in time in the future. Now, another clause that trust should have is to provide family income protection. So if I were to die tomorrow and there's a $2 million death benefit being paid to that family trust, I want to give my wife the ability to go into that trust on an annual basis and pull a percentage of the trust. It could be a percentage like 5% of the trust assets. So at $2 million, that would be $100,000 every year. Now, obviously, that trust that paid out of the $2 million death benefit will be invested by the trust. Sometimes it could be just the interest that the trust provides for a number of years, and then, the trust document can allow for invading some of the principal to provide for the benefit and the betterment of your surviving spouse. It should also, another clause that I've seen often is what I call a Social Security income match. So if all of a sudden I pass away, and now my surviving spouse is going to take my Social Security benefit because it's a higher one of the two, then I would want this ILIT or this family bank to pay a Social Security income benefit equal to the one that was lost at the first death. Because as you know, under Social Security rules, if you have a husband and wife and they both contributed to Social Security benefits and they're receiving Social Security income, at the first death, the surviving spouse is going to take the highest of the two Social Security incomes that were coming into the household, but they're going to lose one of them. So by having a clause inside a family bank irrevocable life insurance trust, then you do have the ability to pay out on an annual basis a Social Security income match, and you can add an inflation payout on an annual basis, so the survivor can now maintain his or her standard of living out of those Social Security payments. Now, many of the clauses that I have seen inside these ILITs also include for business opportunities. So let's say that you have one of your children who went to college or didn't go to college but has a trade that they want to explore. Let's say you have a child that is a plumber and they're certified and they want to start their own business. Well, this ILIT can provide for a business loan. Now, it's not going to be free money. It shouldn't be free money because at the end of the day, you want to keep that ILIT in place for generations to come. So therefore, if that child needs, let's say, a $50,000 loan in order to open a plumbing business and to make it a profitable plumbing business, then the trustee to that family trust or that family bank can dictate, how long should it take for that member of the family unit and that child to pay the loan back, what the interest rate should be. It should be an interest rate above and beyond what he or she can collect or can get out in the marketplace, because this loan is a loan that will not require any guarantees or it will not require any qualifications of any sort. So because of the fact that even if you borrow the $50,000 and you happen to be the child and you're using that, even if you got to pay another point or another 2 points above that back into the family unit, well, that is part of the family unit because you are a beneficiary of that family trust. So if you're going to help anyone and you're going to pay more interest to anyone, why not pay it to yourself into the family unit and trust overall? Now, another clause that I have seen is that a properly structured ILIT should provide for a generational life insurance program. What do I mean by that? Well, many of the family clauses dictate that, let's say, in the case of my surviving spouse, if I were to die, tomorrow and there's $2 million going into that family unit, and then my wife has the ability to pull out, 5% per year out of those $2 million in order to maintain, her standard of living along with, our investments and retirement accounts and Social Security benefits and so forth, then a clause could say, well, you're going to take 10%, or you're going to take 15%, or you're going to take 20% of that $100,000 payout, and then that family member that's receiving that payout is now going to buy a guaranteed life insurance contract for whatever the most those $10,000, $15,000, or $20,000 can buy, and make that trust the owner and beneficiary of that policy as well. So upon the death of that surviving spouse, then there's an additional influx of cash and liquidity into that trust for the use of the children and the grandchildren and the great-grandchildren for many, many years to come. And if you do that for every family member, all of a sudden you have income going into your children, which are younger. And if you have now your children take 10, 15, or 20% of that income and purchase guaranteed life insurance contract that will now earmarked for that family bank, then how much more death benefit can they buy, and then how much more liquidity can they provide? And by the time it's all said and done, you can have tens of millions of dollars inside that family bank, where that family generational planning can be done just because of the fact that you had a pioneer, that you had a patriarch that started that thought process of maintaining the relationship between each and every generation down the line. Another opportunity is family banking opportunities for businesses and college education. So if a member of the family unit is going to go to college, what college are they going to go to? How much can the family unit and the family bank support? How much they can pay? And when are they going to pay it back, so they can get all the free grants that they can get that may be available through governmental entities, and then any additional needs and additional money that they need to provide that education can come, from that family bank. And then that child, upon graduation, they're going to have to start paying that loan back. But then guess what? The money going back into that loan is going to be utilized in order to minimize the advantages and maximize the advantages of the family unit for years to come. So this is something that can be done over and over again with children and grandchildren along those lines. Now, another thing that can be done with family unit planning is you plan obviously for grandchildren and great-grandchildren, and many, many other things that can be done from a business standpoint. I do have my biggest client has a family bank that is now at $22 million in life insurance proceeds. Now, some of those policies have already paid up because some of my clients have already passed away, and there's a lot of money inside that family bank. And the trustee has a tremendous amount of responsibility because of the fact that now that trustee has to abide by the clauses and the determining factors inside of the requirements that are needed in order to create that family bank and that family legacy along those lines. So again, we've talked quite a bit about some of these things, and I just want to give you some final thoughts that I think can drive a point home. And this is something why I'm trying to get each and every one of my clients to not be part of the statistics, to not be, that 99% of American families that are going to remain poor for generations to come. I want them to become part of that 1%. And if I can give you education, if I can give you information, and I don't care, whether you're going to start your family legacy program with $1 million or $10 million life insurance contract. I know a lot of people can't do that, but even if you start with $500,000 or $300,000, you're becoming the pioneer. You start to, move that that needle to the right in making it the right way. And by the way, some of these family members that I deal with, that I have created these family banks and irrevocable life insurance trusts for, they have a family meeting once a year, and they have a trust meeting once a year to make certain that everyone that is part of that family trust understands, the impact of family benefits and the role that each and every one of them play when it comes to determining their viability inside of that family unit. So what are my final thoughts? Just a few of them. ILITs, or irrevocable life insurance trusts, must follow the laws of perpetuities. Nothing in the United States can last forever. And there are laws of perpetuities, and every state have their own laws of perpetuities. Usually the laws of perpetuities are 21 years after the death of the youngest beneficiary in the original trust. So let's say that you set up a trust today and you have a 1-year-old in that trust, or let's say that person happens to be a grandchild. So you set up the trust. Let's say you're a husband and wife. You're setting up this family bank, for yourself and your wife. You have your children. You may have 2 to 3 children. You may have a number of grandchildren. But let's say that the youngest grandchild is 1 year of age. If that youngest grandchild is 1 year of age, 1 year old, then you can go out to the mortality of that child, and let's say, for argument's sake, that the mortality for that child is age 80. So now you can go 80 years down the road on that trust, plus 21 years past that the mortality rate of that youngest member of the trust. So in this case, since the mortality of that 1-year-old was 80 years of age, you can now go another 21 years, and that would make that trust 101 years old, and you can keep it without any challenges and any problems along those lines. Now, as time goes on, under those trusts, you're going to be setting up sub-trusts that will continue to move the point of perpetuity further and further down the line. So it's important to note that. If you want more information, obviously you can reach out to me and I can fill you in how to do all that. Now, the other thing that you need to consider is that life insurance actually acts as life assurance. See, there's a difference between life insurance and life assurance. Life insurance usually dies. Life assurance is going to last forever. So you also have to think that life assurance is like money in escrow. And escrow closes the day someone dies, and the escrow would be that irrevocable trust that is going to take all of those assets and that is going to start dissipating the assets according to your goals, objectives, and desires when you set up that irrevocable trust to begin with. Another thing that I can tell you, and this is something that I have lived through a number of times already, is that no one ever dies at the right time. I don't care how old you are. I don't care how old you're going to be when you die. No one ever dies at the right time. So having proper life insurance and life assurance protection is paramount in order to maintain the survival of yourself, your family, and the family unit overall. Another thing that I can tell you, because I have delivered a number of death benefit claims already in my 30 years of doing retirement distribution planning, tax planning, and insurance planning, is that I have never met a widow that did not believe in life insurance. I would also argue that I have never met an irrevocable life insurance trust that did not believe in life insurance. And I have never seen a family unit not benefiting from a guaranteed cash flow in retirement. Once again, I have never seen a family unit not benefiting from guaranteed cash flow at retirement. That can only be done, unless you have been very successful in business, can only be done if you're going to do it strategically and you're going to do it the right way. It can only be done with the stroke of a pen. So if you truly think about life insurance, and I do hear this often, well, Bert, I don't believe in life insurance. Well, first of all, life insurance is not a religion. You don't have to believe in it. Life insurance is a financial instrument. But if you understand what that financial instrument can do, not only for you, but also for your family, and the guarantees that that financial instrument can provide, then you're definitely going to become a believer, not necessarily in what life insurance is, but what life insurance does. So thank you so much for giving me a few minutes of your time today. Obviously, this is episode 121. For those of you that may want to reach out to me and pick my brain on this particular subject matter, if you want to be one of the part of that 1%, feel free to call me at area code 786-766-1042. You can also reach out to me at my email address, Bert, B-E-R-T, at bertsalazar.com, B-E-R-T at BERTSALAZAR.com. And always remember that my goal for you and every one of your family members, and this is my goal every single week, is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, stay safe. Thank you for giving me a few minutes of your time, and I'll talk to you again next week. Take care.